It's just below 18 at the close today. Let's bring in our closer today, Terry Duffy, the CME Group Chairman and CEO, joins us now from Chicago. Terry, good afternoon to you. Thanks so much for joining us.
Thank you, Wilfred. Appreciate you having me.
So talk us through what you think about those volatility levels, given all of the big macro risks and concerns we've had in the last couple of weeks and the pullback from those highs. Do you gauge it as a reasonable jump in volatility? You expect more?
I think the word you just raised is a good one, reasonable. I think it is reasonable volatility compared to what's going on in the world today, Wilfred. I mean, you talked about the coronavirus, you talk about what's going on all throughout the Asian communities, you talk about what's going on here in the United States geopolitically. There's a whole host of issues where I think that the volatility is at a reasonable level, and I guess some could say it could even spike higher. But at the same time, you know, I think what we're here to do is to manage that volatility, and we're doing it. But we are seeing quite a bit. And I will tell you, Wilfred, most of it is in the equity complex, and then we're seeing a little bit more in the oil complex with the sell-off we've seen recently in the oil markets.
I mean, to talk a little bit more about those different levels that we've seen year to date, equities, oils, bonds, when you see how much more of a risk aversion move we've seen in things like oil and bonds relative to equities, does it make you pause and think that equities are due a bit more of a pullback or not?
Well, I mean, it's really difficult to predict that because, I mean, who would have predicted that we'd see Tesla stock at $700 and some odd today, up $100 and some odd for the day. So it's really tough to say what's going to drive what market down to what level or up to what level. We're seeing the equities at all-time highs, we're seeing interest rates at all-time lows, and now we're seeing energy. If you look at it, it's basically in the mean. It's at 50 some odd dollars a barrel, so you take the 130 or the $20, and you're kind of in the middle to the lower end of it. So, you know, it's really hard to make a prediction if this is going to continue dragging the equities one way or another.
You see anything related to the election, Terry? Obviously, Iowa caucuses today, and Sanders is gaining some momentum.
You know, Sarah, that's a great question. And I think, you know, we don't have enough time on your live show to discuss it, but I think it's going to be the first time that you're going to see, if we have a very progressive government coming in, that you could see a whole new pricing of assets. And I'm not sure they're going up or down, but it's a whole new philosophy than what we've seen historically when people come into that White House. So if we see a progressive movement and coming out with Bernie Sanders being the front runner, which it appears he will be, you could see more pricing of assets in a different way over the several coming months as we go through the election.
What does the sort of term structure of various hedging options tell you about how quickly we could see the market react? Would just a victory tonight see a big revaluation, or do we need to get past Super Tuesday and see the nomination fully confirmed?
Well, I think you, again, hit the nail on the head, Wilfred. I think when you look at the way the markets react, they don't give you a whole lot of opportunities, and they react very quickly. So I'm assuming we'll see some kind of reaction with the Iowa, and then you'll see reactions going into Super Tuesday and beyond. So I think every time we have this kind of momentum, whether it's an election or something fundamentally in business, you're going to see a quick reaction, and then you'll see it come back one way or another. No different than what we saw Friday with the coronavirus, and everybody said, well, let's take a wait-and-see approach going into Monday, Tuesday of this week, and then instead we saw a rally. So you never know. It seems like the reaction is very immediate, though, no matter what the situation may be.
Terry, how about Bitcoin? Having a great January, up almost 30%. What's with that? Is it a safe haven? And what are you seeing in futures?
You know what, Sarah? I think it is. I think, you know, people are using Bitcoin a lot like they're using gold today, and I think it is a bit of a safe haven. We're seeing an uptick, as you referenced, in Bitcoin. It's sat at that level of 7,000 of Bitcoin for so long, and then you have an uptick to 9,000, 9,500 on the Bitcoin. We just listed options on Bitcoin a couple of weeks ago, starting to get a little bit of interest there. But we are seeing more and more people participate in Bitcoin. But I think you hit the nail on the head. I think it's more of a safe haven, similar to a gold trade.
Terry, as we watch these markets, there's so much more attention now on the systematic trading systems, on whether it be, you know, hedge funds that target a certain level of volatility or ones that are, you know, risk parity using futures and interest rate instruments and against one another. Has that fundamentally changed the rhythm of the market at all, as far as you can tell? And what has it meant for your business?
You know, Mike, I don't think it's changed the rhythm too much of the marketplace, you know, other than, you know, passive versus active type managers. So they need to either do more layoffs or less, you might say. But I think that our business has been pretty steady for the most part, and people need to manage that risk, even though I think when Wilford started this conversation out, he said the VIX is still right around 18. So even though it's up significantly, it's coming off of a very low base. So I think people need to manage that risk, Mike, and that's not going to change. There's just too many events out there that can happen so quickly, and if you're not already hedged up, it's too late after the fact, Mike. So I think that you'll see more and more people continue on with this, no matter if it's passive or active in the marketplace.
Terry, so many people understandably link your business and the trading desks of investment banks to the macro outlook, and therefore can get a little bit concerned and bearish about where things are heading, given where we are in the cycle. I was at the Goldman Sachs Investor Day last week, and it was clear that they felt the returns for their trading business could improve significantly in the years ahead, regardless of whatever the macro environment is. How do you feel about your broad business at the moment? Of course, there's been some regulatory challenges both in Europe and here in the last couple of years. Some of the smaller players have fallen away. Do you feel in a strong position to grow both bottom line and top line in the next 5 years?
Well, I mean, it's really difficult to predict what your top line and bottom line are going to be. CME is 80% of our revenues derived from transactions, but when you look at just the financials in general, especially the banks, last several months they were reporting out some fairly significant upticks in their FICC trading and other businesses. That's good for CME because we do all the layoffs and we have the capital efficiencies with all our treasury products and our Eurodollar contracts to give the offsets against the cash. And then with our acquisition of the Next Exchange, we're going to have the broker tech sitting alongside of our futures platform, which again will create more and more efficiencies for people mitigating that risk. So I think it's a really good thing. And you're seeing the financials. More and more people are participating in the markets, and I think they have to, just to mitigate the risk, that the unknown risk, as they say.
Terry Duffy, good to see you. Thank you.
Thanks, Sarah.